This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
The first section of our conceptual framework goes through there and looks at the objective of financial reporting. So looking at why are we preparing these financial statements and who are they for? Okay, so what we've got here is effectively we've got all of these transactions that are happening there within a business. If you look at some of the large listed entities around the world, there's billions and billions of transactions happening on a day-to-day basis in terms of buying the raw materials, paying wages and salaries on a monthly basis. You've got all of your credit sales, all of your cash sales. It's just crazy, isn't it? So what we need to be able to do is we need to be able to summarize those results, don't we? And that's effectively what we're doing with regard to our financial statements. We're providing information that is useful. Okay, that's a key focus, isn't it? The information that we have to provide to whoever it is useful. It gives them benefit. Otherwise, it's a waste of time. Okay, so it needs to be simple to follow, easy to understand. Okay, I know that's not the case with a lot of these accounting rules, but that's underpinning everything, isn't it? The usefulness. Who does it need to be useful for? Our investors. So whether that is the current investors that we have or our potential future investors. Lenders, so our banks, and then any other creditors. So effectively our suppliers. Okay, so we're providing the information for the investors, the lenders, and our suppliers, okay, our credit suppliers, because they need to go through there and look at the resources that the entity has. So effectively looking at the assets that are under the control of the entity and looking therefore at the claims against that entity. So we have our assets in terms of our economic resources. The claims against the entity are the amounts of money that effectively are outstanding. So how much do we owe to the tax authorities? How much do we owe to the banks? How much do we owe to the debt investors? And how much of this business do the equity shareholders own? Okay. So effectively what we're seeing there is we're looking at what appears in the statement of financial position, isn't it? The resources of the entity, the claims against it, are looking at the assets, are looking at the liabilities, and we need to give them useful information about the assets and about the liabilities, because these potential investors, the lenders, that's effectively looking at the financing requirements that a business needs. So if we have a surplus of assets over our liabilities, then the business isn't necessarily looking to be able to go through there and raise additional finance, is it? Because the assets that we have are currently covering our liabilities. So the business is looking liquid from a short-term perspective and solvent from a long-term perspective. Okay. We then go through there and look at the changes in those resources and claims. So this comes back effectively to what we said in the introductory video, whereby the focus of the framework is very much on the measurement on the statement of financial position. Because if we can get that correct in terms of the resources of the entity, the claims against it, so the assets and the liabilities, then the changes in those resources are effectively what we see there in profit or loss, and other comprehensive income, isn't it? Okay. So what we've got there is effectively the objective of financial reporting is to prepare a statement of financial position, a statement of profit or loss and other comprehensive income that gives useful information to the users, which are our investors, our lenders and our other creditors, our providers of finance. However, don't forget that there will be other users of the accounts. There will be the government to look at your job creation and looking at the amount of taxes that you're paying. Your customers might want to go through there and look at your financial statements. To go through there and see how well this business is performing and whether or not the custom can continue. You might also go through there and have your competitors looking at your financial statements to see your margins and your overall level of profitability based on the assets that you have within the business. Your environmental pressure groups will be looking at your corporate and social responsibility. So looking at, yeah, great, you're generating all of these profits, but are you doing it in a responsible fashion? You may have heard of the UN's Global Sustainable Development Goals. Okay, they are a set of goals. I think there are 17 of them, whereby we're looking to eradicate poverty. We're looking to go through there and reduce water wastage. We're looking to go through there and reduce pollution of the seas. So maybe we'll begin to go through there and address those issues within the narrative. Okay, but here the framework is very much focusing more upon the numbers aspect, and that's one of the limitations that we see in later chapters of our financial statement. It's very number orientated, isn't it? Okay. So what are then these qualitative characteristics? It's making sure effectively that these financial statements meet the objectives of financial reporting, to make the information useful to the users of the accounts. So what you've got here, and this would have been some type of question that you have within, or had within financial accounting, is asking you to remember what were the fundamental qualitative characteristics and what were the enhancing qualitative characteristics. Okay, so effectively what we're saying here is that you have your statement of financial position, you have your statement of profit or loss and other comprehensive income, which per the framework will be prepared on an accruals basis. So using the matching concept. And here it's trying to improve the usefulness. So making sure there that on your fundamental qualitative characteristics, that the information is relevant and is presented faithfully. Okay. So when you're looking there at relevant information, it needs to make a difference to the users. So you will give that information. So this is where it brings in some of the non-computational aspects, if you like. So looking more at the qualitative aspects in terms of the disclosures, because we need to put in information that is useful, that makes a difference. And it makes a difference to the users if it's looking at the nature of the transaction and the materiality of the transaction. Okay, so something can be material by nature or just purely by its size. So you see a bit of IS-24 related parties in strategic business reporting. You know, those related parties, some of the transactions that happen might not be material in size, but by nature, by their definition, they are. Okay, because that could help influence the decisions that are made by the users, knowing that a lot of the transactions that we enter into are with related parties. Okay, and therefore we have a little bit of control or influence over that transaction. Okay, so it has to be relevant. Okay, so therefore it has to be up to date. So something is relevant if it is there at its most up to date fair value, isn't it? If there's a material difference between the current fair value and the most up to date fair value, we will process that adjustment because it's relevant. So bringing it into IAS 16 and property, plant and equipment revaluations. If there's a small change in the revaluation, then we're not going to worry about it. It's not relevant, is it? But if there's a significant increase in the value of that property, plant and equipment, it's material by size, so therefore we will process it as an adjustment. Faithful information is making sure that the assets you present, the liabilities, the income, the expense, the equity, etc., has all the information that you know about it at that point in time. Okay, so you need to make sure that you're not waiting too long to go through and get that information. Okay, it needs to be as complete as possible at that point in time, because the longer we wait to get that complete information, then the less relevant it becomes, doesn't it? Okay, you know that the most faithful information that we have is if we were to sell that property, plant and equipment that we're looking to revalue. But if we leave it long enough, then it loses its relevance, doesn't it? So we need to go through there and make sure we've got a good measurement basis, i.e. fair value, to give that complete information. Okay, it needs to be neutral, so there's no bias. So we need to make sure that you've got your accounts that are there audited, because that will then ensure that any bias, any errors will be spotted, hopefully, or material errors anyway, and therefore that information that the users have can be relied upon. If the information can't be relied upon, then the decisions that will be made may be incorrect. Okay. So the fundamental qualitative characteristics are relevant and faithful information. Remember that, but also remember their application. And then there, your enhancing qualitative characteristics, comparability, verifiability, timeliness, and understandability. So comparability means we need to make sure there that we have comparability, not just from one year to the next, but also from one firm to the other. And if we're preparing our financial statements using IFRSs that are underpinned by the framework, then we can have comparable information, can't we? If there's changes in accounting policies, then that's fine. But we just need to make sure there that we go back and retrospectively apply the change in accounting policy so that we have comparable information from one year to the next. Okay. Verifiability. So the more verifiable, the more we can actually back up those numbers, the better that is. So have we got the ability to trace it back to invoice? Have we got the ability to trace it back to cash receipts, cash payments? But if not, doesn't necessarily mean that it is less verifiable. We just need to make sure there that we're following the rules with regard to measuring fair value. Okay, so that's why we've now got a standard, IFRS 13, that gives us the specific rules about how to measure fair value, because that then ensures that the values within our financial statements are verifiable. Okay, we have something to tie them back to. Timeliness comes back to a little bit to do with the faithful information, doesn't it? We said before that it needs to be complete. We need to make sure that the information that we get is complete and completed within a relevant time scale, isn't it? Because the longer it takes us to get that information, the more that information becomes less relevant, doesn't it? Okay, so that's why we go through there and begin to look at IS 10, your events after the reporting period, and look at what happens between the reporting period and the dates that the accounts are authorised for issue. Yeah, because that should be a suitable amount of time to give us the relevant information about what we need to be able to prepare useful information within the financial statements. And understandability. This comes back to what we said before. To be useful, it needs to be simple, doesn't it, and easy to understand. But not everything is simple. Not everything is easy to understand, is it? That there will be some complex transactions. If you think financial reporting is hard, wait till you get to strategic business reporting. Okay, same rules, more complex transactions. Okay, it makes it more difficult, makes it more of a challenge, brings it in more real world, higher level application, doesn't it? But we can't just turn around and say, well, you know, to be useful, it needs to be simple, easy to follow. That's difficult. Yes. Hide it under the carpet. Let's move it. It's not relevant. It's too difficult. Okay. So in order to be understandable, what we need to make sure there is that the users of the accounts have a reasonable knowledge of the business and the activities that it does. Okay. Because if they have a reasonable understanding of the business and what it does, they will then be able to use that to help them with their reasonable understanding of accounting, to then help them make those useful decisions. If that's the case, then if we can follow these qualitative characteristics in all of the transactions that we enter into, then that information that we have that is portrayed within the financial statement, so within the statement of financial position, looking at the assets and the liabilities, so the resources and the claims, and looking at the changes within them, then that information that we have is going to be useful. The more useful it is, the more informed decisions that can be made by those investors, the lenders, and the other creditors.